Welcome to the NEO ETF show on Asset TV. I'm Claire Hara of the Globe and Mail, and I'm joined today with Christopher Dahl, Vice President, ETF Sales and Strategy at Invesco. Welcome, Christopher.
Good morning. Thank you for having me.
So last year you added to your lineup of equal weight ETFs, and you added one to your European market. So I just wanted to get your thoughts. What is equal weight investing, and what are the benefits to investors?
Sure, great, thank you. I think when talking about equal weight, it's always just good to start with a conversation around what the flaws of market cap weighting would be. And so from our perspective, there are a number of flaws. One, market cap weighted investing is generally backwards looking, generally very concentrated in the large cap names. So you've got a concentration bias and a tilt towards larger names. They're prone to market bubbles, and there's no systematic rebalancing or no benefit from that rebalancing. So with that as the backdrop, I think it's important to maybe define what equal weight investing is. And so from our perspective, it's generally taking the universe of stocks and giving them an equal weight. So let's take the S&P 500 or the European 350. You're taking all 500 names and giving them an equal weight. So 0.2% in the US for the S&P 500 or 0.28% for the equal weight 350 approximately. And then from there, the benefits that we see are specifically designed to offset those flaws of the market cap weighting. So you have that more diversified approach. So you get better representation across all the sectors, not so concentrated amongst each individual security. And then more importantly, because there's that quarterly rebalance, you get that systematic harvesting of winners and reinvesting in those securities that have underperformed.
Well, let's talk about performance. How have these strategies been performing over time?
Yeah, and so with smart beta strategies, the performance ebbs and flows. So in the case of equal weight, it's had a very challenging couple of years here at the tail end of a long bull market, which is normally what we see for an equal weight strategy. But longer term, the performance has been quite strong. If you look out 10, 15 years, we see over 200 basis points of outperformance of the equal weight strategy versus its underlying benchmark. And that's really what drives the performance. Coming back to those benefits, some of what that performance is being driven off of is the fact that you're more diversified, you're tilting away from those large cap names, so you're picking up some mid cap exposure. And then as well, you're reinvesting those proceeds, or that rebalancing forces you to sell your winners and reinvest those proceeds into those securities that have underperformed. So there's that natural mean reversion that takes place within the strategy.
So if an investor or an advisor wants to incorporate this into their portfolio, what should they be thinking about?
Yeah, there's a couple of ways that we've seen investors use this well. So one is as a replacement strategy for their core market cap weighted approach. And so what they're doing there is they're taking their S&P 500 market cap and fully replacing it with the S&P 500 equal weight. And in that case, the reason for that is they have the same 500 securities, but better diversification, better representation across the universe. On the flip side, we do see some clients pairing the strategy up with their existing sleeve of equity strategies. And in that case, what they're trying to do is add more diversification, add a better risk return profile, and give their clients a better outcome to their portfolio.
How does the cost of these strategies relate to market cap or active strategies?
Yeah, that's a good question. And generally when we look at smart beta strategies, it's a combination of the best of active and the best of passive. And so you think of something like a low volatility strategy or an equal weight strategy that have been around for years. All you're doing in this case is you're leveraging what institutions or academia has researched over time and putting it into a systematic index rules-based methodology. And so there's the blend of the active and a blend of the passive to get that. And so when we think of pricing the strategy, you do see a spectrum from your low-cost passive to smart beta, which is in the middle, but still well below active, and then active sort of a little bit more expensive. In the case of the two equal weight strategies that we launched last year, the S&P 500 is priced at 25 basis points, and the European 350 equal weight is priced at 30 basis points. A little bit more expensive than your traditional passive, but again, a lot lower than the active strategies.
Thank you so much for your insights today, Christopher.
Thank you. It was my pleasure to be with you today.
And thank you for watching the NEO ETF show on Asset TV.